You muted yourself. Oh, okay, good. All right, guys. So let's go ahead and get started. Good morning. And man, I'll be honest with you. I've been really loving these technology and the Zoom calls. The merry month of May has been good to me in terms of really proving this process of I've written, and with Aaron there, yeah, we've written a few apps already now online and doing this business online and being able to go multi-state and just kind of cross state boundaries just through Zoom has been just an incredible tool for us to learn and grow a business. Today I asked our CEO here, Mr. Dago Zuniga. I called him, I believe it was Wednesday or Thursday, but I said, brother, we need this presentation. Now, what you're going to learn today is something that I learned from this guy, I would say back in 2005, with an exception of a few tweaks here and there due to product shifts. But I would say that 95% of this presentation has not changed since then. And I think it's very, very important information that you guys realize that what we do is absolutely phenomenal for the client. And when you really understand the power you hold with your life license and what you could teach, I think it's revolutionary. And we're at such a great place in time because of the evolution of technology. And honestly, our industry is dying. There's such a shortage of people that can do what we do. The people that could do what you're learned today are the average age in our industry is 59 years old. Okay, this is actual statistic. And so this is becoming completely wide open because a lot of the senior guys that have been in this industry for a long time are kind of starting to retire, slow down their practice, or they're being, outpaced by technology. A lot of guys that I started with the industry, when they look at this, are like, I have no clue how to work this stuff. And they're kind of still doing, dinosaur methods of networking and doing business, which, hey, still works, to each their own. But we want to get on with the track. We believe by 2025, this is going to be the preferred way of doing business. And the principles do not change. So you really want to take notes on this, because this little presentation that you're going to learn today, we've literally helped thousands of people. And this guy right here, I could tell you, right? I even asked him, I was like, man, how many times have you done this presentation? He's like, oh my gosh. But I kid you not, right? I said, how much do you think you've earned by this presentation, doing it with clients? He's like, honestly, man, like if we look at it from 2004 until present, it's probably been millions, since I've done this, right? And so you want to look at something that's tried and proven and tested and actually gets results and actually gets across to the consumer, and people just, I get it, and they move forward. Then you're going to learn from someone that is, in my opinion, one of the best in the industry in terms of serving clients. So not just because he's the title of our CEO, but he's just a phenomenal producer. And you want to learn from people that know how to get results, and this guy has done it, man. And, I'm proud to have learned a lot from this guy. And those of you that are new, you will really appreciate what you're going to learn today, because it's that valuable, So I would, grab a notebook, take notes on this, because once you go into screen share, and we're going to try to knock it out in the short amount of time. And that's why we have it recorded, because this is going to go into our back office for training. So, without further ado, I'd like to bring up the man, our CEO, Mr. Dago Zuniga. Let's party, brother.
All right, can you hear me?
Loud and clear.
Awesome. So I'm going to go ahead and jump into it. Thank you, Carlo, for the introduction. And, as we, I've actually thought about this too myself. And when you asked me the other day, well, how much have you generated? I would say personally on my own pen, and I don't say this to boast at all. And I come from a place of, and I'll share with you my story, my background, how I got involved in the industry and what really inspired me to just take some, just to really dive into this industry. As you guys can know, I don't know if most of you have known, I haven't met some of you guys here. My background, I actually was an engineer for 5 years. I'm just going to go ahead and dive into that. I grew up in a little tiny city where there was only one stoplight. I don't know if you've ever heard of it. It's called Arvin. It's based out of, it's a little bit southeast of Bakersfield. So if you've ever you haven't lived if you haven't gone to Bakersfield or Arvin. In my opinion, you got to go check it out. And so growing up all my life, I heard go to be a doctor, a lawyer, engineer, or a teacher. And everybody was saying, Dago, you're pretty good at numbers. Why don't you study engineering? And so here I was off on my way to UC Santa Barbara. I studied mechanical engineering. In 2000, I landed my first corporate job at a company called Raytheon. So I was that type of person that would come in when it was dark, leave when it was dark. I was just really excited about getting after it with my first career. How many of you guys have ever heard of that saying that if you work hard, you'll get recognized and then you'll get pulled up, right? Maybe you'll get into a supervisory position, and then from there, where do you go next? Management position. And so here I was doing, putting in the hard work, taking on more projects than most because I wanted to excel and I wanted to stand out. So when it was time for my first review, I remember my boss sliding over this white sheet of paper, and he had a big smile on his face, and he said, "Turn it around. What do you think?" And when I turned it around, it was, a little raise that I received for the year, and it was a whopping 4%. Now, I was grateful that I received an increase in pay, but I was a little frustrated because it was the exact same thing as the person next to me who wasn't putting in the same work that ended up receiving the exact same thing. So to me, I started thinking to myself, is it really worth to, come in on the weekends or put in this extra time when I'm just going to be another number at a corporation? And so it caused me to step back and look at my life more objective. And I thought to myself, what can I do to separate myself from the bunch, right? From all my peers? And what could I do so that I could improve and actually make more income? Because at the end, all I ever wanted, my personal motivator, and I'm sharing this with you guys, I wanted to be that financial rock for my family. I wanted to be able to write a simple check to my mom and dad and say, "Mom, Dad, let me treat you to this nice vacation," or "Let me take care of your mortgage." And sadly to say, I couldn't do that. And so I was like, okay, what do I do next? So what do you guys think that I did next? I said, well, let me further my education. Let me go get a master's, because if I get a master's, I'll increase in pay, I'll stand out, and I'll start to climb the ladder. I started attending USC. I ended up transferring and finishing it at Long Beach because in 2004, one of my best friends, who was also an engineer, introduced me to his financial advisor. So when he said, "Hey, I have a financial advisor, you got to sit with me," I think somebody else is waiting here. He said, let me meet with him. But I was more blown away with, like, how the heck do you have a financial advisor? You're such a young, we're friends. Sure, I'll sit with him. So when I sat with him, I was 27 years old. And the gentleman across the table from me, he was in a sharp suit. He was 27 years old as well. And he was sharing with me some concepts that were just mind blowing to me. Because I started thinking back in my mind as he was sharing these concepts, I'm like, where in my formal education did I miss this? And I couldn't find any class, even with the business courses I took in college, where they teach you about personal finance or paying yourself first. Some simple concepts, right? That should be common sense. There was never a class. And so I started thinking about my family. I started thinking about my parents, my uncles and aunts, my friends, people that I felt really needed this information. And so I started selling myself to him and I started asking him, is there any possible way that I could get involved with your company? Maybe do this as a twin career or do it part-time. I definitely know a lot of people that can benefit, starting with myself first. I am hungry. I didn't realize I was thinking about changing careers, by the way, just a side note. And I really wasn't. And so I started selling myself. He said, "You know what, Dago, you seem like a good person. You seem a little overexcited. Why don't you come back to the office next week and we'll talk specifically regarding that?" And so 2004, it was about February, around that time frame. And I still remember showing up to the office and they gave me an opportunity. Luckily, I was being trained by somebody who was already financially free at that age. And so obviously he knew what he was doing. But just like most people, we naturally have this, like, I don't want to say we're all skeptical, but we want to investigate. We want to do our research. We want to understand things. We want to understand how the gears come together. And so I was, especially myself as an engineer by education, I was spinning my wheels trying to figure everything out. And I finally came to a point 6 months into the career of doing it part-time while I was juggling graduate school, was where I had to shut off that voice. And I said, you know what? It's not serving me. Let me just do as they're teaching me. After all, they are the experts, and there's no way in the world you could do something illegal unless you are just lying on paperwork and things like that. So it's a licensed profession. So let me just go ahead and dive in. The minute I did that, things started to really change for me. 6 months from the point that I finally, was licensed. And at that time, by the way, guys, you needed to have a Series 6, 63, 26, and a life and health. So in order to make a penny, you had to have all these licenses. And so for most people, when you think about a 1 year, I mean, all of us, just speaking frankly, is 1 year a long-term type of a deal if you're in business? No way. For most businesses, if you go in and you're lucky, if, for instance, if you're in the restaurant business, it's going to take you hundreds of thousands of dollars, in many cases, even millions, to get into that industry. And you're not guaranteed you're going to make your money back, or you're going to be in business within the first 1 to 2 years. So I thought to myself, gosh, if companies like Japanese companies have 50-year plans or more, like 1 year is nothing, especially if I went to, you know, if my undergraduate was 5 years and then graduate was 2 years, there's just 1 year is nothing. So I'm going to focus in on the fundamentals. I'm going to really learn this. I'm going to focus on getting tons of experience so that I could see as many scenarios as possible from the top trainers. And so I set myself to do that. When you know, a year later, I think I took a little too long with the training. I took it really to heart, and I thank goodness for it though, because it was a foundation. The moment that I got licensed, my first month doing this part-time, I made 6 times my income than I was making on a monthly basis as an engineer. And I still remember that first month when I sat down with my, you know, the person that was training me. He said, "Why don't you come to my house, bring your business plan, and let's review it." And so when we sat down, he tells me, "Dago, you know," he puts it down, "how much did you earn last month with us? And how much did you earn at Raytheon?" And I was like, oh my gosh, I know where this is headed. He said, "You need to fire your boss tomorrow, or don't ever come back and step foot in our office again." I was like, oh shoot. Have you guys ever seen those movies where everything just kind of goes quiet and you can hear every little step, you can hear every door open, you can hear every little squeak and crack? Well, I remember walking down the hallway at Raytheon, and the hall just kind of stretched out. And as I opened the door to my boss's office, it went, I walk in, and whoo, he wasn't there. Next day I went back, you know, it was the best feeling ever. But I'm sharing you with this information. It might be a little too much for you because of the topic of today, but I share this with you because my background wasn't in finance. I've become someone that's, I would consider myself fairly knowledgeable. I don't want to say that I know everything, because if anyone ever says that, I would say run away from them, because that's not true. You can never know everything. There's always, and that's one thing that's exciting about this industry. You're always on the forefront. You're always learning, and it's information that you could take for the rest of your life with you that is powerful. In fact, that is priceless. Let me let this other Miss Jody in. And so 12 months from the point that I was licensed, I hit over $250,000. I wasn't the fastest, I wasn't the smartest, but I found something that I could really stand behind proudly and know that I was really making a difference in people's lives. The actual topic that I'm going to go into today, I literally, with my own pen, and I say this not boasting, I've made millions of dollars by helping people. So when you look at, you know, in any business, and to make that type of money in this industry, it's because you're really servicing people and you're really taking care of people. So I probably say that because I've dedicated myself to educating and empowering people and allowing them to have choices so they could make educated decisions for themselves that can take care of them for the rest of their lives. So that's what I want you guys to know up front. We've helped thousands of people. I've trained other individuals to make really multiple 6-figure incomes and doing extremely well while they're building a business in this industry. So I'm going to dive in. Let me open up my PowerPoint. I think, Carl, I don't know how I switched over to you into presentation mode, but let me go ahead and share.
Go to share. And while you're doing that, I don't know if, like, on your end in the queue, I've been getting text messages saying, hey, we can't get on because the host has to give us permission.
I just allowed Jody on. Jody was the only one waiting.
Gotcha. Okay. I think people were trying. Okay. No worries.
I think, yeah, we'll fix that for the next one. But it's kind of like the old school way. If you show up late, the door's closed and you're out. You know what I mean? I don't really care to cater to people that are just, you know, it's okay. So let's go ahead and dive into it. And maybe I'm just a little old school that way. I'm gonna share my. So I'm gonna share with you some topics, and then I'm gonna use some whiteboard in combination with going over just some facts and some information I want you guys to think about as I'm going through this. And this is something that I created, gosh, this was 2012, but when I start going into the sketching mode and showing you some illustrations by hand, it's literally something that I learned since 2004. And it's been the same thing because the chassis of most products are very, very similar. Every different company offers different bells and whistles. And there's always good and bad to every single product and every single company. So I want to make sure that as I go through this, don't overanalyze it. Just absorb it, take notes, and just really listen in close. Let me go into PowerPoint mode here, the presentation mode. Here it is. Awesome. So really a question I want you guys to ask yourself, as I'm asking you, is how would you feel if you could have a definite game plan for your financial freedom, giving you the necessary steps that would provide safety, number one, safety, certainty, and the freedom to focus on the most important people and things in your life? I mean, just this simple question for me just made me really think about it. I mean, how many, I've come across so many different people where they're like, oh, I'm invested in the stock market and this is the average return, or this is, I'm like, but are you guaranteed it's going to get you there? Do you know for a fact, is it written in a document there legally that you're guaranteed? And the answer is no. In fact, that's like the anti word that you could ever use when you're in that industry, especially in the securities industry. That's where I did my first 10 years of my, 10 years of my career. That's what I was doing. I was helping people invest in the market with different types of portfolios. And there's no way you could ever do that. So I feel extremely good about being able to provide this certain game plan for people where I could tell people to the like literally to the penny in some cases, and in a lot of cases actually, at worst case scenario, what they could take to the bank every single year, no matter what, rain or shine, if the market's up, down, or sideways. And that's extremely powerful, because one of the things that most people are fearing nowadays is, number one, that they're not going to get there. Number one is they don't have a clue on how to get there. Number one is that they're ever going to get there. Number two is, if they do get there, are they going to, another 2008 might happen, or another 2000 or 2003 might happen to them. So people are just literally uncertain. They're walking that quiet life of desperation, and they're really nervous because they have no clue, and they don't have a definite game plan on achieving financial freedom or having that comfortable financial lifestyle when they go to retire. I was gonna dive into like the different steps that we take with people, but I'm just gonna give you a macro view. Everyone that we sit with, it doesn't matter if it's with our affluent clients or with people that are just getting started. Literally, we have the full array of our spectrum of different types of clients. We could tailor a customized strategy for every individual, and we design it around their current budget. Now, obviously, if their goal is to reach X, but their income or their savings is just not there yet, well, we'll start with something smaller and we'll start to build up to that point. But the thing that's beautiful about what we do is that we don't charge a penny for our service. We get paid extremely healthy by the different companies that we represent. We're a broker. So I always tell my clients, hey, look, I represent you. I could care less about the different companies, because everyone's going to try to solicit and sell you. I mean, you could walk into your local bank, for instance, as an example, and it's all about their agenda. They're trying to sell you what's on their shelves. They're never going to tell you, hey, go across the street. There's a better rate across the street with my competitor. They're not going to do that. Everyone's in the business for themselves when it comes to that. So for us, what we do is we represent you. We're going to find the different companies that are going to fit you best, the different vehicles, and then you can make an educated decision by going over the good and the bad. But you're definitely going to have a definite game plan so that you know exactly what it takes to get to your goals. When it comes to proper protection, to increasing your cash flow, to making sure that your kids go to college, to also reaching your retirement goal. So here's some roadblocks that we all face, and this is general across the board. The first roadblock is people are concerned with volatility. We've seen this again. You can look all the way from 2000 up to now. Right now we're at a high, right, in the market where everyone's like, all right, the market's up, et cetera, et cetera. But have you guys noticed this? As everything supposedly is up, the cost of living is also increasing. Housing is also increasing. So how great is it really when you really think about that? The other thing too is this is what happens in the general population. Most people are passive investors. And what I mean by passive investors, have you noticed that when the market's up, everyone seems to be up? And when the market is down, everyone seems to go down with it. And so everybody's riding this roller coaster. I tell my clients, like, look, if you're completely in the market and you're still going aggressive in the market, here's the challenge you face. If you were in 1999 trying to retire in 2000, and the market just started going down for 3 years straight, you don't know exactly when it's going to turn back up. You can't predict that. You can't market time that. It doesn't work that way. So can you imagine people had to stay working? And it literally took 7 years from the point from 2000 to 2007 for the market just to break even, especially if you kept investing. Most people pulled out. Can you imagine trying to retire in 2008 and all of a sudden, boom, your account drops by half? Or being retired in 2008 and all of a sudden, especially if you're working with, say, dividend incomes, where like, say, for instance, with unit investment trusts and you're receiving income, let's say you were receiving $100,000 a year from your investments and all of a sudden, boom, the market drops and now you're receiving only 50% of that. So it could be a drastic effect on your lifestyle, your money. Maybe if you're taking medicines, I could go on and on and on, but people are extremely concerned with volatility. And right now, if you were to ask anybody, it would be safe to assume that you probably heard that the market's at a high, it's around the corner, we just don't know when, where there's going to be an adjustment because the actual interest rates are still kept relatively low. Actually, they're kept really low. And so what are the chances of them going even lower? I don't know. I'm not going to guess for you, but it seems like everything seems to cycle and we're about due for that. So that's my personal belief. Now, the other thing that's a roadblock for people is people are frustrated with, really low returns. We've seen now in the last 5 years, the interest rates, like for instance, let's look at 2008, 2009, even 2010, even 2011 until most recently, the interest rates were like less than 1%, maybe even 1% for a CD. Now they're creeping up to about 2.5. You'll get some that are around there, but you have to lock up your money for 5 years, put a lump sum of money in there. So they're starting to creep up just a little bit, but they're still really low. That's not even keeping up with inflation. If inflation is approximately 4% or so, are you keeping up with the cost of living? You're not. So it's really, really low rates of return, and people are frustrated with that. But it's a whole lot safer, right, than just leaving your money on the side or being completely invested aggressive in the market. Now, and the other thing people are really worried about, and I think this for me, let me admit this, for me, this is the number one that people do not think about whatsoever about, which is paying unnecessary taxes. They're worried about taxes, but they have no absolute clue. If we're going to have our partner with us, which I call Uncle Sam, for the rest of our life right next to us, wouldn't it make sense that we also know a little bit about taxes and how to shelter our money so that we don't pay too much in taxes? Now, I'm all about paying taxes as a good citizen. I'm all about that. I believe in taxes. But can you imagine having Uncle Sam in your pocket every single step of the way your whole entire life? There's ways to actually pay your share and then avoid paying too much, have your money grow tax deferred, and be able to withdraw from it tax free. And so there's strategies that we share with people so they could reduce taxation. So here it is. And then the last thing that people are really nervous about is outliving their retirement. I've sat with different folks where they're withdrawing money from their accounts, but yet when we do when we backwards calculate, we're like, wait a minute, you're literally going to run out of money within 7 years, or you're going to run out of money within 9 years. Are you aware of that? They're like, and they put their head down. They're like, I know. It's like, I just need to take out all this income. I'm like, well, we got to put your money in a different type of a strategy where even if the account goes to zero, you're still getting a check for the rest of your life. You may not get the same. You're going to have to, you'll get a little bit less, but at least you'll have peace of mind that you'll never run out of money. And so we'll show people how to overcome that concern or that nervousness of outliving their money. So let's talk about the money game, because I think this is very important before I go into like sharing with you sketches about a program that literally I feel is extremely beneficial for people. Wall Street is teaching us these rules, and they're teaching us average rate of return, which I'm sure you guys have heard of. Hey, look, if I invest here and there and we take an average, I'll get my average rate of return. Or if the market goes up and down, just take the average and this is my average rate of return. So let's study that a little bit. That buy and hold mentality. Hey, look, everything goes up. Just buy it and hold it and everything goes up. So we'll dive into that too really quickly. And then, hey, the market always does an average of 12%. Have you guys heard of that before? We're going to examine that as well. And then the market always goes up. Yeah, sure. If you look at the chart and you look at the historicals of what the market has done, everything goes up. But hey, sometimes they've forgotten to also share that inflation also goes up as well. But we'll study that. So let's talk about the average rate of return. So here's a little illustration for you. for you to consider. If year one, you earned a 50% rate of return, and then year two, you lost 50%, and then year three, you earned 50%, and then year four, you lost 50%. So it looks like, okay, it was a wash, right? Because it looks like, well, this should be zero, because if you do the average, if you subtract just the returns themselves, it makes sense. I didn't lose anything, right? In those 4 years. That's what it appears like from at a glance, but let's take the average, okay? Supposedly zero. But let's look at this when it comes to your money. And this is where I want you guys to really focus in on. Don't focus in so much on the returns. Focus on your money. Keep your eye on the ball, as my coach used to say, right? Keep your eye on the ball. It's your money. If you were to put $100,000 in and you gained 50%, which is beautiful, you're now at 150,000. If the next year it went down 50% and you're now at 75,000. So no, you're not breaking even. And if you gain another 50, you're now at $500,000. And then if you lose 50%, you're now at $56,000. So what's your actual rate of return? It's not zero. It's actually negative 43.75%, which is crazy. So, you know, you really got to look at the, whoops, let me go back. So keep your eyes on your money. Wall Street wants you to keep looking at the percentages, but really the true story is told there on your money. Now, the average rate of return, this roller coaster, you know, everyone says, you know, the market's always performing at 12. If you were to even look at the S&P 500, for instance, which are the Standards and Poor's, and you look at the historicals all the way up till the end of 2010 in this illustration, it looks kind of like an EKG, right? It's all over the place, right? You're riding that crazy roller coaster. So when you look at this, you look at the next one, which is as an example of the Nikkei index from 85 to 2010, you know, was at a peak at one point, and then it just started to decrease for many years. So not so true when it comes to the buy and hold strategy. So what I'm trying to share with you is this. I'm not trying to be a pessimist or be negative or be anti-stock market. I'm just saying that it only makes sense that, especially if you're going to deal with your retirement, that you have a nice amount of money that's going to get you there with certainty, regardless, no matter what. So you're just not riding the roller coaster, crossing your fingers, hoping that the market's on the up. But you still have to worry about your retirement phase when you start to withdraw. So a lot of my wealthy clients, what they do is they understand that if they want to play in the market and they want to, you know, trade and hold certain funds or companies that they really like, et cetera, or day trade, by all means, go for it. I personally got away from doing that, and I started focusing in on strategies that were guaranteed. And that's one of the things that I love, is that I can sleep comfortably at night. I'm not getting phone calls like, oh my gosh, the market's up. Oh my gosh, the market's down. Or, you know, I don't get those phone calls. In fact, I have a very, my book of business is, no one ever calls me in regarding, unless they want to add more money or they want to make a small change, but it's really low maintenance. And so, let me just dive forward because I really want to dive into, there's a lot of facts that show the different returns. I'll do this on a different time, but because I don't want to take up a lot of the time just going over. All I'm trying to share with you is do your homework. Do your homework when it comes to really understanding the true story behind even 401ks and all the hidden fees. You know, most people are not aware of those things. So as you start, that's another thing that I really love about being in this industry, is that it pushes you to like really dive in and start to understand how these programs are created and why, and what is actually the underlying truth. And the numbers share the story. Did you guys know that in 401ks, they're not required to show their actual employees the fees? Recently, I think it was like 2008 or so, they passed it where they were supposed to disclose certain fees, but those fees were only disclosed to the employer. So if somebody comes in, say from X, Y, and Z company and says, hey, look, we'd like to provide a 401k, give us an opportunity to be able to manage that 401k for your company so that you can provide it to your employees. Here are the fees. Before, they didn't even have to disclose that. It was like, here's a 401k, you match them in a couple bucks. It's a benefit for your company. It helps with retention, et cetera. You get to reduce anything you match as well at the end of the year from your taxes. I mean, there's a lot more to the story. But 401ks really weren't intended to be a retirement plan. They were created in the 70s, and you can look up these magazines, read the articles, where they were created for executives that were getting these large bonuses, and they needed somewhere to shelter some of that money. And so they created something called a 401k plan. It wasn't called a 401k retirement plan, just a 401k plan. So, but most people are aware of these, or they know about these, because if they work for a company, they're able to get these benefits. Or if they offer this benefit, they take advantage of it. And you would hope they do, at least. So there's more articles. Wharton's Financial Institution, which is one of the top business institutions, did some studies on different types of funds. They go into studying even indexes. So what we focus on is index strategies. At least, when people ask me, Dago, what do you do? Is like, number one is I help people protect themselves and their loved ones. I make sure that they're properly protected. That's one. That's one thing. Then the second thing is we create strategies to protect people's assets and create that longevity. And we do that mainly through fixed index strategies, where you could actually participate only with the positive returns of the market up to a certain point, but you don't participate when another negative. So we've eliminated all the negative possibilities of what the S&P can do or any of these index strategies. So that's a beautiful thing, because really where your money is really affected is in the losses, because recouping, if you were, like I was showing you in those numbers earlier, if you lost 50% and you're at 150, you're now at 75. When you gained 50%, you only went up to 112. Remember that? So you literally would have to have almost like a 70% return just to be able to recoup in that year where you were at, where you started, if the market really dropped that much. So it's the losses that also really affect you. So here's Warren Buffett's investment rules. Number one is don't lose money. Number two is don't forget rule number one. And so obviously it's about protecting your money as part of your strategy. So it's not just about an offensive strategy, it's also having a defensive strategy. Again, go look up these research reports, this Kresman research study that looks at the S&P 500. If you were to look at professional money managers and their performance against the S&P 500 index, only less than 2% of professional managers have ever actually beat the S&P. So can you imagine? I always tell people, what's so professional about paying a professional money manager to help you lose your money? Here's what they're always going to tell you. Keep your money in the market. Why? Because they get paid for assets under management. If you're out of the market, they're not getting paid. So of course, there's always going to be this battle between the insurance world and the financial institutions where they're managing assets, because they want your money in the market. So there's this constant thing. For me, I could care less of any two institutions. I want to make sure my client, it's what's best in it's whatever's best in their interest. What strategy is going to get them there with certainty? And if I shared with you earlier, if most people are passive investors, most people, like for instance, when I was an engineer, I was focusing on my career. Just like if people are lawyers or construction workers or teachers, they're so consumed with their career and their family life. Most people don't have the time, training, or temperament to go in there and start dabbling with funds. There are a lot of people that do well doing day trading. I'm not saying that, but most people are just riding that roller coaster. So I don't believe people should ever lose a penny. And I at least want to provide that option for people, because if they could still get market-like returns, that's powerful. So here's where I'm going to dive into. And then from here, I'm going to start writing some illustrations, because I want to talk to you guys about unnecessary taxes. This is the number one killer when it comes to people's money, and people need to think about this a lot more. And the way taxes work is you earn it, you get taxed, you spend it, you get taxed, and you save it, you get taxed, you die, you get taxed. From birth to death, all the way through, we get taxed. And so shouldn't we know a little bit about money? About taxes? Absolutely. Let me share with you the 3 places where people can actually put their money. And this is across the board for everybody here in the US. The first place is in the red zone, which is the taxable. The second place is tax deferred, where there are government plans. You're telling Uncle Sam, don't tax me today, tax me later, tax me in the future. So these are called tax deferred strategies. And then the third area is tax advantages. Some people call them tax exempt. I don't like the word exempt because it's not true. In my opinion, you're going to pay taxes one way or another. But tax advantage sounds a whole lot better, right? So out of the 3, if I were just looking at taxable, tax deferred, tax advantage, which one sounds better just by the looks of it? Obviously, tax advantage. I firmly believe you need to have money in all 3 different areas, and there's a reason why, and I'll share that with you now. The first place, which is taxable, and this is where if you work for a company, you receive your check, and you're investing now after tax dollars. So it's already been taxed once. But if you notice the little circles that show the little green areas, it actually shows here that you're getting taxed all the way through, because you also have to report whenever there's any interest earned. At the end of the year, you'll get a 1099 statement, that little beautiful love letter from Uncle Sam saying, hey, your money made money, so you're gonna have to pay us taxes, state and federal, especially here in California. You're gonna also have state. And then at the end of the year, you have to do your income taxes. So then there's taxes again. So taxes all the way through. Is this the smartest place to put your money when it comes to retirement? In my opinion, when it comes to taxes, absolutely not. When it comes to liquidity, depending on what type of account you're in, you should have money there, because if you're trying to go on a vacation, you want to be able to possibly earn a little bit more money or a better return. If you want to buy, if you have some midterm goals, but you have more of that liquidity, then you definitely need to have some money there in that area. A lot of it because, the possibility of earning a better return and because of liquidity. The second area is tax deferred. Tax deferred, these are going to be like 401ks, 403B for teachers or nonprofit organizations, 457s if you're a city, state employee. You'll also see teachers with 457s, TSA, tax sheltered annuities, TSPs, thrift savings plans. You'll see folks in the military or people that work for the post office, they'll have plans like that. Tax deferred, anything that pretty much is called tax deferred or tax deferred comp, all that stuff that you're not paying today and you're paying in the future, they fall in this area here. And so with these strategies, I always tell folks, like, look, if a company is giving you a match of say 100% up to 4%, take that free money all day. And if you can max it out, even better. But you definitely want to have also some money in this other bucket I'm going to share with you next, because at the end, when you go to retire, because that money's never been taxed, you're going to be taxed on the back end. And right now, and I'm going to share with you next some actual graphs to show you the federal tax margin, but we're actually at the very lowest point that it's been for many years. I personally would not chance, leaving it till, you have all this money that you built up and all of a sudden you get rocked with taxes. So everyone I've ever asked is like, do you want to have a tax-free retirement or a taxable retirement? Everyone always says, of course, tax-free. I'm like, well, did you realize that all your money is actually in a tax-deferred bucket, which is all going to be taxable? They're like, oh, wow, I never thought about that. And so again, definitely take advantage of that free money. But if you're paying over the amount, take that money and let's put that into a different type of a strategy where you're actually going to have some tax advantages. So the tax advantage column, this one shows municipal bonds, Roth IRAs fall in that bracket, and then also cash accumulation inside of a life contract. Some people call them LIRPs, life insurance retirement plans. Most people are not aware of these. So with these strategies, you're paid the taxes up front, because once you receive your check, you're putting, money's coming out of your savings or checking account into these strategies, and it grows tax deferred. And then when you withdraw from it, it's all tax free. So you definitely want to build up. I'm not saying put all your eggs in that basket, not at all, but you definitely should have a percentage of your money that's coming in tax free. And ideally, if you could build up and hit your goal with this being tax free, wouldn't that be a lot better? Absolutely, right? So those are the three different areas. In a minute, I'll share with you how I draw it out, and I draw it in more detail. And it's literally been the same presentation since 2004 that I've used. I've never really used, to be honest with you, a PowerPoint when I'm with the client. It's all just, I'm just an educator. I'm just showing them some concepts. I'm showing them in general how they work. And people are always scratching their heads like, how come I didn't know about this? I'm like, well, I was in the same boat as you. And that's why I love sharing this information. That it kind of fuels me, because I see that look in people's face. I'm like, okay, we're gonna clarify a lot of this confusion, and we're gonna make sure that you're taken care of. So here's a question for you to consider. Would you, if you're a farmer, would you rather pay taxes on the seed or on the harvest? Obviously the seed, right? But chances are you're probably paying it on the harvest, especially if you're participating in those tax deferred strategies, and the majority of people are paying it on the harvest. But this little simple illustration, just shows you, I would personally rather just pay it on the seed than on the harvest. But most people, again, are doing it on the back end. So let's look at the tax brackets. I'm going to go ahead and fast forward. I want you guys to look at these historicals. Now today, we're actually at about 37% when it comes to the federal tax margin. But if you look from 1913 all the way to today, and I should have put a more current graph, but I didn't, you're actually going to see that it's been held down, for a very long time. And it was in the 70s, which is not too long ago, that it was actually in the 70 percentile. And if you were to look at what's happening in the U.S. with all the debt that the U.S. has, with Medicare, with all this stuff, I mean, that's going on, where do you think the money's actually, let's even talk about Social Security. Right now, we're paying way more out in benefits than we're collecting in taxes, which is not talked about enough. There's just not enough people that are putting into the system. It was people, like when Social Security was actually created, they didn't realize people were going to start living longer. But now with breakthroughs with technology, you take a pill here and you live, longer. Yes, something falls off you, but you live longer. People are just living longer. So again, looking at all those things that are going on, not to dive into each one particularly, because we could talk all day about them. Do you think taxes might go up or down? I mean, I can't predict the future, but I definitely don't want to position myself to be for a big, nasty surprise when I go to retire. I want to make sure that I'm grandfathered in, I'm paying, I've paid my taxes already, and all my assets that I've accumulated, at least majority of them, can be tax-free. So you can look at these numbers, look them up yourself, even if you just go into online and Google it, look for credible sources, and you'll start to find that, oh my gosh, we are at a very low. It's unbelievable that even at times that we're in the 90 percentile when it comes to taxes or federal tax margins. So let me get out of this. I'm going to go ahead and draw a couple. Actually, let me go ahead and dive into this one. I got to share with you this one because this is kind of a cool little illustration. There's literally 4 phases of retirement: contribution phase, the accumulation phase, the withdrawal phase, and then the transfer. So those are the 4 phases. If we were going to look at, say, IRAs or these tax deferred strategies, this is the way it's going to work. When you're contributing into this bucket, and I'm going to refer to them as buckets. When you put money into this tax deferred bucket, it's going to be tax favored. Absolutely. Because today, if let's just say you put money into an IRA and you put $6,500, if you earned $100,000, you get to reduce that. It looks like you actually made, what is it, 94 or 93,500 for the year. So that's going to be your reportable income. So it's tax favored today because you're deferring it for later. As it's accumulating, it's tax favored because it's tax deferred growth, which is awesome, right? When you go to withdraw it, I'll share with you, but I'm going to just do a comparison with, say, the life insurance retirement plan, which is the tax advantage strategy. I'm only doing this comparison because, again, most people are not aware of these, and I want to make sure even though they're, if we're almost in a sense comparing them apples to apples, but we're just comparing the different phases. So up front, your contribution is after-tax dollars, okay? So again, you paid it on the seed. Your accumulation phase, though, is actually tax favored. So it's growing tax deferred while it's inside of this account, which is beautiful. Now let's go back up to the 401k. When you go to withdraw from it, you're going to get charged what's called ordinary, and the key word is this: ordinary income tax. Like, that's what you're going to have to report, whatever you withdraw. A lot of people always tell me that, I thought that when I go to retire, because I'm older, I don't have to pay taxes on that money. And I almost want to chuckle, but I'm like, and I have to stay serious because a lot of people tell me that. I'm like, I'm sorry, Mr. and Mrs. Client. It's not income tax, it's income tax. It's actually what you withdraw. You have to report it, whatever is reportable income. They're like, well, I thought when I'm older that I'm not going to need as much money. I'm like, okay, well, let me ask you a question. Would you like to receive 100% of your current income when you retire? Or do you want to just retire with like way less money? Most people would say, well, gosh, I wish I could retire with more money than what I'm currently earning because it's pretty tough to live on what I have now. I'm like, well, you got to consider these different things. If you have grandchildren or children, wouldn't you want to probably spend a little more time with them? You're going to have more time on your hands, obviously, because you're retired. You're probably going to want to travel and treat yourself to certain things. Well, that's going to require income. And so chances are you're going to at least want to withdraw close to what you're earning now. And so you got to consider those things. So again, it's taxable. Now, when you go to transfer, when it goes on to the beneficiaries or the next, the children or so forth, it's also taxable because it's now an asset that's being received. So think about that. So look at the little tiny piggy. You end up with very, very little. But one of the things that when I start to sketch it out, you're going to see some other facts that are going to be like, whoa, like I didn't know about this. The other thing now when you compare it with the LIRP type of life insurance type of strategy, the withdrawal phase, if you do it properly, it's tax favored. And then when you go to transfer it, it's beautiful because it's all tax free under Internal Revenue Code 101A, and I'll share with you that in a minute. So when you're comparing those 4 phases and those type of strategies, which one has more on your side? It's the LIRP plan. It's investing through a life insurance strategy. But again, always a lot of people always say like, oh, like life insurance, I don't really want life insurance. Like I'm young, I'm gonna live forever, like, or whatever they feeling they have against. I'm like, look, you don't have to love it. You just have to like it enough or like it more than you like Uncle Sam or paying so much in taxes. Because they have the internal revenue codes that are really favoring these strategies, and affluent people that get access to these types of portfolios, they're aware of this and they put a ton of money into these, because when it moves on even to the next generation, it's all completely tax-free, or even the beneficiary is just completely tax-free. So it's a pretty powerful strategy. Again, you have to structure them properly, and I'll talk to you about that here in a minute. But there's internal revenue codes that you could go do your research on. I mean, I'm sure if you went to the IRS, website.gov, you could start doing research on these types of these section codes. You could write them down if you like. There's 7702A, which is one of them, which makes it a private plan, which I'll dive into in a bit. And then there's the 101A, which was way before 401k and those type of strategies. But 101A means that any money inside of a life contract or any life policy, when that person passes away, let's say you have $1 million policy, that $1 million will go tax-free to the beneficiaries, which is beautiful. And then the 7702, which is the private plan, that one gives you flexibility within these strategies. So it almost becomes, there's a lot of liquidity involved, and you don't have to wait till the 59.5. You don't have to worry about the 70.5, RMDs, which is required minimum withdrawals that you have to take out of these accounts. I know I got a little technical here for a second, but I'm going to start to paint the picture. So let me go ahead and get out of this and go into my whiteboard mode. Oops, let me share this screen. Okay. So literally, I'm going to dive into, again, the different tax scenarios. This little pad is connecting. Okay, here it is. Perfect. So there's literally only 3 different places you could actually invest your money. Let me go ahead and draw this out. Like I mentioned earlier, this is going to be tax now. This is when you invest money in stocks, bonds, mutual funds, even money in the bank, like in CDs, money markets. So here, you've already been taxed once because you put in after-tax dollars, like I mentioned. If let's just say that you put in $100 and now your account did extremely well, now you have $200 at the end of the month, you got an awesome rate of return. Well, Uncle Sam says, hey, wait a minute, your money made money. This is a capital gain. So we're going to charge you here in California state taxes and also federal, which is actually, whoops, let me leave it right there, which could be approximately about 40% or so, maybe like a 30-40%. So you get taxed again. Then at the end of the year, you have to report your income tax. So taxes again. So all the way through, you're completely exposed to taxes. So again, like I mentioned, not the smartest place, especially when it comes to retirement. You definitely want to have money there, like I mentioned, because of liquidity for most of these accounts, and you want to have access to that money now, or you want to make a major purchase or invest in something else. So you want to make sure that you have that. All right, so let me go ahead and dive into the next one over here. This is the tax deferred strategy. The tax deferred strategy, these are going to be like your 401ks, 403bs for teachers, for instance, and also people that are nonprofit, churches, even hospitals, 457s for state employees. You also have your tax sheltered annuities, your thrift savings plans, your tax deferred comps for some police officers. I mean, anything that's tax deferred. You also have the popular ones you're probably familiar with, like your IRAs. The IRAs have a few set of rules that I want to dive into. This from 2018 to now, if you're less than 50 years of age, it's $6,500 you could put in per year. Once you turn age 50 or more, you could actually put $1,000 more, so it's $7,500 per year. But the one thing you have to consider is that there's also some other set of rules. Once you start earning too much income as an individual, Uncle Sam says, hey, wait a minute, you made X amount of money, you passed this threshold, you can't open one of these accounts up. You could legally open it, like you could walk in and open one up, but then all of a sudden, what does the IRS do once they figure it out? Like 2 years later, they're going to penalize you plus interest, etc. So once you make too much money, you definitely can't. The other rule that most you should be familiar with is that you can't touch these accounts until you're 59.5, or else you get what's called the early withdrawal penalty of 10% plus taxes. A lot of people I've come across where they'll take out their money. They're like, I just moved jobs. You know, I have $100,000. Let me go ahead and withdraw it out. Let's just say that you're earning $100,000. I'm going to go ahead and draw it out right here. Let's say you're earning $100,000 a year and you took out your $100,000. Well, that $100,000, you're going to pay, number one, $10,000 up front because of that 10% penalty plus taxes. So you're going to end up maybe more or less with like about $50,000-$60,000. Let's just say hypothetically just 50, just to keep it simple. When you go to report your income tax that year, are you going to report 50,000 plus 100,000, or are you going to report the full 100,000 plus your 100,000 that you earned? It's actually going to be the full 100,000. So boom, again, taxes again on the back end, because now you've actually reporting 200,000. So now the other thing that most people are not familiar with is the 70.5 rule. 70.5 rule says that there's something called a required minimum distribution. You have to start withdrawing. Guess what? Because Uncle Sam has his eyes on all this money that hasn't been taxed, and he wants his tax money. If you don't withdraw the required minimum, you're going to pay a 50% penalty for the money that you're supposed to withdraw that year. And every single year it starts to increase because you're supposed to take out more and more money out. So that's another rule that I want you guys to be aware of. Let me go ahead and admit this person. One more person came in. Perfect. All right. So now, let me find my little pen. Where'd it go? Here it went. So then the other thing too, that's the good news is that after 59.5, there is no capital gains tax. So you don't have to pay this over here. And I think this is where most people get confused and they think, oh, that's what's tax-free. So the good news is you don't have to pay that there. Now, the bad thing, is on the back end, where you're going to get charged what's called ordinary income tax. So let me draw that out. It could be anywhere between 30 to 50%. So let's just say hypothetically that you're putting in $500 a month, and you did that for 30 years. And let's say, assuming that you averaged a 12% rate of return, that's 1.7 million. It's a little bit more than 1.7 million, but I'm going to go ahead and just draw it out this way, assuming that it's 1.7. If we were going to use 50% just for simplicity's sake, that right there is what, $850,000 that goes in taxes to Uncle Sam. Now, I don't know about you, but this right here is way too much money for me. That's half your account going in taxes. A lot of people are like, oh my gosh, that's way too much. But this is literally where everybody has their accounts, and there's 401ks and IRAs because they're choosing to defer and save on today. Now, obviously, if you can max those accounts out and you still have money to be able to put into these other like tax advantage strategies, then that'll be ideal. I think savings is savings. It doesn't matter where you save as long as you're paying yourself and you're saving money. But you should consider, you definitely need to be looking at the taxes because it's what's really going to affect you in the long run. So let's go ahead and go over here to this tax advantage strategy. The tax advantage strategy is either you put money into a Roth, you could put into municipal bonds, but let's just go into Roth, or a life contract, right, where you could build cash accumulation inside of this. And so with these accounts, there is no capital gains tax. By the way, let me just first share this with the IRA, or the Roth IRA is very similar to the IRA over here. Same set of rules apply, except that you're actually putting after-tax dollars in. But the good news is you don't have to pay this over here, this capital gains, because it's growing tax deferred. But the beautiful part on the back end is that when you start to withdraw, it is tax-free, which is huge. So wouldn't it make sense that you have some money, at least in the tax advantage area? Absolutely. So these are the three different areas which you could actually put your money. Definitely you need to have money in the tax now bucket because of liquidity. Tax deferred, absolutely, especially take advantage if a company is matching you, take that free money. But you should also have some money, in my opinion, in the tax advantage strategy. So let me go ahead and draw what this life contract looks like and which one's the most popular, not popular, but which one's the best one in my opinion to date. So let me go ahead and go to the next sheet and draw that out for you. Literally that little piece that I've showed you guys there right now, on a side note, is a lot of people are scratching their heads like, how come I don't know this stuff? Like, I feel like I should know this, and it's not being taught. Just basics, right? Now, the IUL is hands down, in my opinion, the best one in the industry right now. When I first, in 2004, what I was doing a ton of was VULs because the IUL didn't exist. And those are variable universal lives, which are extremely expensive. And again, the client is assuming all the risk because you have to go in and manage your portfolios. They have portfolios inside of them, just like 401ks do, different mutual funds. So there's, you know, a ton of different strategies you could choose. But again, you're leaving it now up to the client to dabble with that. Now, if you look at the IUL, I stands for indexed. There's different companies offer different index strategies, but the most popular one, which is a benchmark one to follow, is the S&P 500. You could pull up your phone right now and look at the performance of the S&P and what it's done in the last 3 months, the last 5 months. You can look at it daily if you want to. I wouldn't get too excited like that to look at it daily, but the S&P is really strong. If you look at the average rates of returns that it's done in the last 20, 10, 5 years, 3 years, it's done really, really well. So the U actually stands for universal, which means flexibility. And this will allow you to put quite a bit of money into these, depending on how we structure it. You could even skip some months if you needed to. You could put more money in the future if you'd want to. It's all dependent on the design, but it definitely gives you a lot of flexibility, unlike a lot of these other different type of strategies. And then the L stands for life, which is the insurance component. And this is extremely powerful. I'm a huge advocate for insurance now that I've learned a lot more about them. If I'm going to pay, this is the way I personally feel. If I'm going to pay a fee to anything, I would rather get the most benefit, the most valuable possible. I strongly believe that everyone should have one, and especially if at one point you're gone, you want to make sure your family's taken care of. Or what if you live? You want to make sure you're taken care of. So these policies could take care of you and the people that you love when you're gone. So that small fee that you pay into that is definitely well worth it. With professional money management, you're just paying for possible performance. But again, like I mentioned earlier, if the market's up, down, or sideways, you're still gonna have to pay fees, right, when it comes to that. So if you were to compare apples to apples on fees, all day, you get way more value, hands down, when you go through the life contract. Now, let me go ahead and draw out a little illustration to kind of paint the picture on how it looks. So I always like to draw it into two components, even though it's all under one umbrella. But you have on one side the insurance side, and then you have on the other side what's called the cash value side. Let's just say, hypothetically, that you had a $500,000 policy, right? Assuming you're, healthy and you get a good rating, et cetera, and you now have this permanent policy. Once you qualify today, you have it contractually for the rest of your life. God forbid you ever became terminally ill or anything like that in the future, you already have this policy. Now I'm going to use the same example I used earlier. Let's say you were putting in $500 per month, assuming you did that for 30 years, and also assuming that you average a 12% rate of return, that is $1.7 million. I already showed you earlier that in the 401k and in the IRA, any of these tax deferred strategies, this money here, because it hasn't been taxed, could be taxed anywhere between 30 to 50%, which again, let's just use 50% to keep the numbers easy, which could be about $850,000 in taxes, which we all agreed that this is a lot of money. That's just way too much. If you put money into a life contract, the rules are completely different. Again, you pay taxes up front on the seed, but it all grows tax deferred. So you could put way more money into these accounts than you could into any 401k, IRA, any of those types of programs. It grows tax deferred, has no capital gains, and then when you start to withdraw from it, it's going to be completely tax-free. So let me give you an example. Let's just say on this side, you built up the 1.7 million and you decide, hey, look, I'm 45 or I'm 50 years of age or whatever, 60 years. I want to pull out 10% of my account. They'll look at this account. They're like, oh yeah, you have like 1.7 million. So they're going to give you $170,000, which by the way, is all tax free. So let's just say that you're like got super excited and you take off to Vegas for the weekend and you're on your last quarter and you just blew 170,000 over the weekend. You're like, you pass over and you die right there on the spot because you have a heart attack. Well, your beneficiary is going to get everything that's inside of this account that's remaining, all of that. So let's just say you subtract the 170, so that's 1.53 million. They're going to get this plus your death benefit of $500,000. So that's $2,030,000 And all of this is tax-free, which is huge, right? So even while you're living, you get to withdraw this tax-free. But on this side, even when you're gone, they get both. Especially if you structure it that way, they get both completely tax-free, which is powerful. Now, the other thing that I jumped ahead on that I wanted to share with you is that on the cash value side, the way this works is you have a 0% floor. And every company is different on the different caps that they put. I'm just going to go ahead and use the 12% cap. Some of them right now are like at 11% or so. And some of them you could structure where there's no cap. So it's all dependent on the strategy. So I'm just going to use a generic number. So let's just say your cap is 12%. What that means is that you have a window of opportunity between 0 to 12%. So if the S&P this year, I'm going to draw it over here, if it earned 10%, guess what? You get 10%. If next year it went down negative 10%, you don't participate in that. Let me go ahead and let this other person in. Someone just jumped in right now. You don't participate in that, so you'll get a 0. But let's just say the following year, the S&P did 20%. Will you get the 20%? You won't. You'll get the 12% in this scenario. So the great news about this is that, again, when you look at the average of what the S&P has done, this is a pretty nice window of opportunity that fits in on what it's actually average, which is extremely powerful. Now, you're not going to, hit home runs with it because, again, you're capped at 12%, but you're definitely going to have peace of mind that you're steadily growing when the market's performing, and when the market goes negative, you're never going to participate. So your principal is always protected, which is beautiful. Now, here, like I mentioned earlier, you could put a ton of money away into these. It goes tax deferred. You get to withdraw from it all tax free. The only thing is with these programs, the only catch is, again, you first have to qualify for them because there is that health component. So that is the important part. But the good news is this. Let's just say you're sitting with somebody or you're sat with an individual that they, for whatever reason, can't get qualified because of health reasons. Well, they don't necessarily have to be the insured. There's also ways where they could be the owner and they could insure somebody else. So those are things for you to consider, that they don't necessarily have to be the one. Just when you own it, you can still take advantage of the strategy as well. But let me share with you something that's extremely amazing with one of the flagship companies that we leverage. There's two different companies that I like to always share with people. And this is after, there's more companies, but every company actually, has their bells and whistles. Hands down, I believe that I'm going to describe these as muscle cars. Let me go ahead. I look at Allianz as like your muscle car, and they also actually do have some riders that will provide some living benefits as well. But with Allianz, the thing that's great about them and their index strategies is that they actually have an in-house where they control that when they're buying the options to do these index strategies, which is beautiful. So you'll get really great performance, potentially great performance with this one. So I call that one your muscle car. Now, when you look at, for instance, like NLG, which is the second oldest insurance company in the US, 170-year-old company, I feel that pound for pound, they offer a full package of a program because it offers all these different living benefits, which provides a lot of peace of mind. And it also has this component that has that lifetime income, where you're guaranteed lifetime income for the rest of your life, which is, I love that part, because once you turn on that income, it's guaranteed contractually to have income for the rest of the person's life. Not to say necessarily on the Allianz side, you can't design it that way. You could. It's just that contractually on the LSW side, actually NLG is LSW. So NLG side, they actually have that part where it's contractually guaranteed that once you turn on that income at age 60, that you could have that. Now, let me go ahead and describe, for instance, some of these living benefits and what they are. The first one, and I'll go through the NLG side. The first one is terminal illness. That means that if the doctor says, hey, you have 24 months to live, you could actually access potentially about 90% of the entire value of the policy, which is pretty powerful. You could use that money for whatever you want. So you're pretty much accelerating your death benefit and the policy to use it for yourself. Now, the second component is chronic illness. If you couldn't do 2 out of the 6 daily activities to live independent or to live normal, like transport yourself, bathe yourself, congestions, those type of things, well, it'll kick in a monthly income of up to 50 months. So it's about a 4-year period or so that they'll pay you a monthly income so that you could use it to whatever help that you need. And then the third one is critical illness. And with critical illness, is God forbid you get Lou Gehrig's disease, stroke, cancer, like all that heavy stuff that most of us have probably heard of, or maybe have had a family member or someone that they get cancer, heart attack, stroke, that kind of stuff, or lose a limb, blindness. Well, it's depending on the severity of it. It could potentially be all the way up to about 90% of the total value. So it's more, these features are pretty beautiful because it gives, like, for instance, when I purchased mine was because I wanted to have peace of mind that what if something happens and I live? Who's going to take care of me? I don't want to become a burden to my family. Well, this gives that peace of mind that I'm going to be good personally. And then the fourth one is critical injury. What if you get in a car accident or something happens and you fall or you have a head trauma or something like that? And I hate to talk about this because it sounds pretty negative, but it's life, right? Well, you could touch about 90% of it depending on the severity of it. So if it's major. And then this is the bad stuff, right? The good one, which is the fifth one, is the lifetime income. God willing, none of this stuff happens and you live a long, healthy, strong life. When you go to turn on income, it's going to give you that lifetime income for the rest of your life, guaranteed. You'll never have to put another penny into it. Contractually, you'll never lapse, and you're taking income for the rest of your life. So life contracts have evolved tremendously. When you look at these types of strategies, look up, for instance, under 101A, this is where, again, it goes tax-free to your beneficiaries. And if you look at 7702, this is what's considered a private plan. So I love that, for instance, let's just say, a year from now, you're like, you know what, I put X amount of money in here, but I can't put money into it for the next couple of months. I'm leaving out of the country or whatever, or I switch jobs. Well, guess what? We'll call the company and they'll look, oh yeah, and the cash value, you've built up this amount of savings. Sure, you could actually take 6 months off. But let's just say on the positive side, you're like, you know what? I came across some money or I got a good income tax return money. I want to dump some more money into this. Well, guess what? We call the company and let's just say you want to put in $10,000. Like, will $10,000 fit, right? Because the IRS puts limits onto these. So anything that has a limit that way, you want to max out. So the company, if you win over that limit, they'll actually send us an email and they'll be like, hey, look, do you want this person to put over the limit? Because now it's going to become what's called the modified endowment contract. Typically, they'll send that money back to the client unless the client says, no, go ahead and make it taxable, which I don't think you'd want to make your account taxable. And then the other thing, too, that I love about these programs, I'll give you a scenario. For instance, I have a lot of clients literally from this spectrum, from people that have put $50 a month all the way up to over 100,000 plus a year. Literally, I have clients that do that. A lot of my clients will do them also in 7 years or even 5 years. Well, they'll just front load it and they're like, you know what? I want to be able to put money into this account and then not have to put money into it for the rest of my life. So a lot of people would do that, especially a lot of business owners or people that have a little bit of savings. They're like, you know what? I'd rather put it in all up front. And the great news about it, and I'm going to go to a different page because I want to share with you this. Let's just say, here it is. Let's just say that you actually have inside of the cash value. I'll give you a scenario. Let's say you put $50,000 or something into this account and you have, say let's just say you have $40,000 in this account now, possibly more. I'm just giving you some roundabout numbers. After year one, you'll have access up to a certain percentage, but if you put in lump sums, you'll have access to a lot more. So it gives you that flexibility that you're able to actually come in and loan money to yourself. You can withdraw from it. I would personally do it as a loan because you'll still have that money here completely working for you as well. Completely working, which is extremely powerful. Now, I'm going to go back and share with you some numbers because I want you guys to understand this on the indexing. And then we're going to finish off there. Okay. So if you look at the indexing, this is a scenario on how it would typically look. So if you notice, starting at the very top, say 99, you put in $100,000. And the different caps, there's always, every year there's different caps because, 0 to 13.5 in this scenario. Year one in 2000, if it earned, say, 21% rate of return, I don't know if you guys noticed this here. If it earned that amount there, well, guess what? You won't get the 21, but you'll get the 13. So now you're at $113,000, which is beautiful. But look at the next 3 years. Remember how I was sharing with you when the market went down from 2000 to 2003? Well, guess what? All these years right here were negative. So you got zeros here, but you didn't lose any money. You're still principal protected. You're at 113,500. The next year it went up, boom, 26, almost 27%. You only received 13. But if you were to do a comparison side by side, and you look at if you were in the market versus not in the market, being in these index type of a strategy, look at the way your money's moving. You're now at 98,000. Here you're at 128,000. So these zeros can be, they call them be your heroes, because you're not participating in the negatives. I could go on and on through all the different numbers. You could look at historicals of what actually has performed, and the way when you compare it side by side. And for me, I would suggest at least having a certain percentage of your money, especially when it comes to your future, that's going to take care of you, and you know that it's going to be there, rain or shine, no matter what. And that's what these strategies do. So this strategy inside of that cash value component, which is huge. So for the sake of time, I'm going to go ahead and go into this camera mode because I think I went over a little bit. Let me stop this. So in closing, here's the beautiful thing. There's a lot of, I've come across other, people that maybe have participated in a program like this, and they're like, oh yeah, I think I have a program just like this. So I always tell them, hey, look, let's bring out your policy, because everyone says, oh yeah, I have a policy that's like this. But then when I actually started reading it and I look at what they actually have, I'm like, wait a minute, let me turn it around. Let me show you in black and white what you actually do have. This is actually the policy you have, and it's not the IUL. And this is the way this one works. And so you'd be surprised that some people think that they're properly protected, but when it comes down to really looking at the facts, you're like, wait a minute, it's not actually what you thought you bought. So people maybe were shared an idea of what they were trying to get, and then they bought something else. So that's one thing I find a lot. I always find a lot that people are way underinsured and not properly protected, or they have old type of policies where maybe those old policies are only going to pay out at death. Well, get the new ones pay out if God forbid something happens, use it for yourself. But as far as like building up some assets and be able to grow your money tax deferred, no capital gains, and then be able to withdraw tax free, and then still have that flexibility, which you could loan money to yourself, you could have that liquidity. Hands down, the 7702 plans, these private plans, are powerful. So you definitely want to have that as part of your portfolio, is have at least some money going into that bucket. I would suggest as much as you can. Now, I'm also not saying putting all your eggs in one basket, but at least having that control and peace of mind as well. So the other thing that I do find is that sometimes when I come across these programs, people structure them incorrectly. They maybe structure it where if they pass away, they only get the death benefit, and all the cash value they built up, the insurance company keeps it. So I always want to look at the details, because a lot of, hate to say it this way, but there's a lot of reps out there that don't know what they're doing, and they're structuring it incorrectly, and they're not positioning them right, and it could in the long run not be the best scenario for that client. So these accounts have to be structured in a way where the client can properly fund them. It has to be structured in a way where both sides, in my opinion, go to the beneficiaries. And then also, if you can maximize and get the most benefits, then we'll look at that and see if there's a possibility to even replace an old policy with a new one. It's just all gonna make sense. But it's all has to be customized around the actual client and what their interests are and their goals are. So we definitely do that. Anyway, guys, thank you for being here with us on a Saturday. Hope you got a ton of value. I'm gonna leave it open for a couple questions before we close out, because I'm sure that some of you guys are probably thinking, well, wait a minute, how does this work? Or let me go ahead, and you could unmute yourself if you have any questions. I'll leave it just for a few minutes for some questions. By the way, the first time I started doing these types of trainings, or getting myself as a trainee, I was intimidated, because I was like, oh my gosh, a lot of stuff was going over my head. But it becomes very simple. I believe that we've taken an industry that's really complex, that's fast paced, and we slowed it down and simplified it and can share it with people in a very simple way. I dove into a little bit more technical, I think, on this one, just because I wanted you guys to get a little bit more under the hood. And so whatever questions you have, feel free to ask me, and I'll be more than happy to answer them. By the way, on a side note, if this was boring to you, thank you for toughing it out, but boring makes you a lot of money. This is very valuable information that everyone can benefit from. Thank you, guys. And yeah, Richard, thank you for participating. Also, Roxy, appreciate it. Aaron, awesome. Keep it up. I know you're up and coming right now, and you've already helping out families. Manny, thanks for being on. Manny's out from Oregon. He's new with us, and him and his wife just got in the business. So, Manny, thank you for participating in our training. Natalie, this information is ridiculously valuable. Thank you. You're welcome. I also got people live here on the Facebook side. Is there any, maybe, don't be shy. Just go ahead and ask a question, because I'm sure that whatever question you have, other people are thinking the same. If not, I'm going to say Bueller. Let's go ahead and close it out then. All right, guys, you guys have a great rest of your weekend. And one thing I suggest that I would say the most, where I personally have learned the most, actually I brought a book. Let me grab it real quick. Study this business. The first book that I ever actually purchased when I got into the industry was an investment book. It was like a little thick green book. It was like an insurance book. Not the most, funnest read in the world, but it definitely gave a lot of technical sides of it. In fact, they were describing these private plans as a Swiss Army knife to financial services products because of all the bells and whistles, the different flexibilities, all the different things you could do with it. The latest book that I'm recommending to people is actually The Power of Zero. I know it looks backwards here from the camera. The Power of Zero by David McKnight. He goes into details, backs it up with facts. He talks about what's going on right now with even taxes and his belief in them increasing. He shows historicals. He shows, how you could actually use a life insurance retirement plan as part of your portfolio and why. He really backs it up with a lot of facts, which I really, really enjoy. There's some audios as well on YouTube. So if you look up The Power of Zero, he's actually done a great job of really just illustrating it. If you look up Patrick Kelly, retirement, he's got a couple of books that also describe this life insurance retirement type of a strategy. So anything with Patrick Kelly, there's 2 books that I would suggest. So if you go to Amazon, go ahead and get the books. I think Patrick Kelly's is also a very simple read as well that you could read in a day. You could read this one in a day as well. Once you start to really understand, you're like, man, why doesn't everyone know about this? Everybody needs to know about this. And you want to, get out there and just share with people. Anyways, guys, have a great weekend. And we'll see you guys in the next one. Thank you. My mouse is stuck here. Technical issues here as I'm trying to get out, guys.